So let's talk about another strategy for super stocks, and it's the Superstock Dividend strategy. And what we like to do with the dividend strategy is we like to invest in superstock companies that have a history of increasing their dividend. And when you receive a dividend, that reduces the cost basis of your stock and allows you to compound your returns. And nice thing about this strategy, there's no complicated math or formulas. So we simply want to identify super stocks by their price pattern in the 20-month EMA and 1-month price, identify stocks that are super stocks, and then we look to see their history of dividends, and we like to see that they have a history of increasing their dividends. We found that the dividend growth rate is a very reliable forecaster of the future earnings growth and the financial health of a company, because corporate directors, they're not going to raise the dividend if they don't believe that the future earnings can sustain the payout. So they're not going to raise the dividend unless they know those future earnings can meet that dividend. So it's a very reliable indicator for companies that are growing their earnings and their general financial health. So if they're steadily increasing that dividend, then those corporate directors are thinking, well, the future earnings are going to be good, and we can pay out that extra dividend, and we can keep increasing that dividend. So this is a great forecaster of good companies to invest in. So again, we use the Superstock strategy. We identify stocks with a major trend system that have consistent and predictable price patterns and that have a history of raising their dividends. And again, these super stocks typically are low volatile. Even though they're low volatility stocks, they outperform the major stock indexes. They have a low number of sell signals, and you're probably not going to get stopped out of these as quickly as you would with a growth stock or a high beta stock, obviously. So we like to focus on these low volatility stocks that have good predictable returns. And when we're selecting these dividend stocks, we use the Keltner Channels again, and to help us identify a low-risk entry point. And again, here's the Keltner Channels. This is the daily price chart of Home Depot stock, and which is this red and black line here, and we have the 3 Keltner Channels, and the we can see this blue line here is the upper Keltner Channel. The dotted line is the middle Keltner Channel, and of course we have the lower Keltner Channel. And when we're looking to buy a stock or an option, we always wait for a retracement and buy that stock or call option when the price of the stock is trading near the middle or lower channel, and we get a much lower risk entry that way. And what we don't want to do is buy when the stock is up above that channel or trading close to the channel, because that's an indication that the stock is overbought, and we want to avoid our entries when the stock is overbought. And we simply wait for a retracement of the stock, and if you wait for the retracement, then there's usually a rally after that retracement. So we can see retracement, rally, retracement, rally, retracement, rally, retracement, rally. So we simply wait for that retracement to buy our dividend-paying stock. So let's look at some Superstock dividend trade examples. This is for Realty Income. This is Real Estate Investment Trust. We've owned this for many, many years, and we trade both options and stock with Realty Income. And nice thing about Realty Income is it pays out a dividend every month. So you really get a chance to compound your returns when you're getting a monthly dividend. And here's an example. We recently added to our position of Realty Income, and again, you can see this is the daily price chart of Realty Income. It's a real estate investment trust, and we have the 3 Keltner channels here. We waited till it retraced towards that middle channel, and then we added to our position. We bought 800 shares of Realty Income at $58.20. So we use the Keltner channels to also help us time our purchases of these dividend-paying stocks. Here's another example. This is for Public Storage. This is also a real estate investment trust, and you can see that this has had a steady price increase since mid-2009, pays a really good dividend. So we recently added to our position of Public Storage, and we waited until it was trading near this middle channel here, and on March 10th, we bought 200 shares of Public Storage at $248. So we bought it right in here when it touched this middle channel. Now it's trading at $268, so we have about a 20-point profit on this one since March 10th. Here's another example. This is the Consumer Staples ETF, and you can see a very low volatile ETF, steady price increases, very predictable price pattern here. So we bought this for to capture the dividends, and we waited till it retraced towards that middle channel, and we bought 900 shares at $51.05. So these are just examples of using the Keltner channels to help us time our entry. Here's one more example. This is for NiSource, the gas utility stock. Again, this one has a 253% total return over the past 10 years versus the S&P with 94%. So I'd much rather own this than the S&P because you can see very predictable price patterns here, very repetitive price patterns. So I'd rather own this stock or a call option on this stock than the S&P. And here's an example. We bought NiSource when it retraced towards this middle channel. We bought 2,000 shares at $22.40. So here's one more. This is Utilities ETF, and we purchased this for the dividend. And again, we waited right in here until the ETF retraced towards that middle channel, and then bought 1,000 shares at 46. This is trading around 49 today. So with these examples, you can see that the Keltner channels allowed us to get low-risk entries as the stocks or ETFs did not retrace much from our entry point. So we like to use these Keltner channels when we're picking out dividend stocks to buy. And this, of course, if you get a low-risk entry, that helps prevent getting stopped out of your position. So let's look at one more strategy here, and it's the married put strategy. And we've been using this strategy for many years. And this strategy is particularly useful when you trade dividend paying stocks, because the dividend helps pay for the cost of the put option. So whenever we have a profit in a stock or an ETF, we normally will purchase a put option to protect our profits. And it's even possible that the put option protection can even guarantee a profit for your stock position. And I'll show you some examples of that. And when you buy a put option, it does not limit your profit potential if the stock continues to increase in price. And then, as I mentioned, if you buy these put option protection on your dividend stocks, then the dividends, of course, will help pay for the cost of the put option. So we've been trading these dividend paying stocks for many years, and what we like to do is if we have a profit in it, then we'll buy the at the money put option, and we'll go out anywhere from 2 to 3 to 4 to 6 months out and buy this put protection, and then we can normally pay a large portion of the cost of the put from the dividends we receive from the stock. So this is a great way to protect your profits and also profit if there's a market sell-off, because the value of the put option, of course, is going to go up if the underlying stock goes down in price. So we buy the put, and let's say we buy the 50 strike put option. If you buy the 50 strike put option, then the value of your stock cannot go below 50. So that locks in a floor on your stock position, and the value of your stock will not go below the strike price of the put. So we simply buy this for protection, and it can even guarantee that we'll have a profit in our stock. So let's look at an example of a married put trade. This was for FAS, which is the financial ETF, and we had purchased the financial ETF. We purchased 200 shares at 106.50. It had a 3-for-1 stock split, so our split adjusted price for 600 shares was $35.50. So we bought 200 shares and 3-for-1 stock split, then we wound up with 600 shares at a cost adjusted price of $35.50. So we had a profit in this ETF, and so what we do is when we have a profit in the stock or ETF, we'll go ahead and buy an at-the-money strike put option, and we'll go several months out, up to 6 months out, and then when the put option is near expiration, then we'll simply roll it over and buy another put option to protect our position. So this is an example of an ETF that we purchased. We had a profit in the ETF, and then we bought the 70 strike put options at $5.90. So had a profit in FAS, wanted to protect that, so we bought the 70 strike puts at $5.90. So when we bought that put, that created a married put spread, and that allowed us to lock in a profit for this ETF, no matter what happened to the price movement of the ETF itself. So, and at the same time, when we bought that put option, we did not limit our upside profit potential if FAS continued to move up in price. So, in this case, again, the married put strategy, whenever we have a profit in a stock or an ETF, we buy the put to protect our profits. This can even guarantee a profit, and it doesn't limit your upside potential. So in this example, we bought the 70 put at $5.90, and we have a married put calculator that will calculate the profit potential for this trade. So we bought the FAS, split adjusted price was $35.50, and then we bought the 70 strike put at $5.90, and we input this data into the married put calculator, and this will calculate the profit potential for this trade, assuming various price changes in FAS, in this example from 150% increase to 100% decline. So I don't expect 100% decline, but we put it in there just to show you that this, by buying the put, we absolutely lock in a profit. So again, bought the FAS $35.50 and bought the 70 strike put at $5.90. So let's look at the profit potential for this. The bottom row here will give us the percent return, profit potential, and again, that's assuming these various price changes in FAS at option expiration. Second from the bottom gives us the dollar profit for this trade assuming these various price changes. And we can see if FAS is flat at $35.50 at option expiration, we'll have a $2,950 profit, and we'll have a 72% return. So you can see even if FAS goes down, we still lock in that 72% return, even if it goes to zero. And of course, we don't expect it to go to zero, but I just put that in there just so you can see that once you buy that put, the 70 put, then the value of FAS cannot go below 70. And we paid $35.50, bought the 70 strike put. So the value of the ETF cannot go below 70 while this put option is in effect. So again, this locked in a profit for us. And even if FAS is flat at option expiration or down 50%, we're still going to realize this $2,950 profit and a 72% return. So this is how we protect our stock positions with these protective puts. Here's one more example of the married put strategy, and this is for TNA. That's the small cap ETF, and we bought the 200 shares of TNA at $52.84. It had a 2-for-1 stock split. So now we had 4 shares, and we paid $26.40 for split adjusted. This price is not correct because with the 2-for-1 split, we would divide this price in half. So it would be about $26.90 is what we paid split adjusted, and we wound up with 400 shares versus 200. So we wanted to protect our profits, and again, we bought the 55 strike put at $5.50. This created married put spread, and it locked in a profit for TNA no matter what happened to the underlying price. So bought 200 shares, TNA $52.84, had a 2-for-1 stock split, and then we subsequently bought the 55 strike put at $5.50, and let's look at the profit potential for this married put trade. And again, this is TNA, small cap ETF. Split adjusted price was $26.42, and we bought the 55 strike call at $5.50. So again, this calculator will calculate the profit potential, assuming various price changes in the ETF at option expiration. And we can see that if TNA is flat at $26.42 at option expiration, we'll realize a 72.3% return. And then if it's up 100%, we still realize 72%. But if it goes up more than 100%, then we start getting into a higher return. And in this case, this is a leveraged ETF, so it is possible for, and we were up more than 100% on this particular ETF. So if the price kept increasing, then our profit potential keeps increasing. And again, if there's a severe drop, 25, 50%, we still will realize a minimum return of $2,308 and 72% return. So that's another example of how we had a profit in TNA, and we wanted to lock in that profit, so we bought a put option for protection, and that locked in a profit no matter what happens to the price of the ETF. And then at option expiration, we would roll that over and buy another at-the-money put option. So this is a great way to profit, especially during volatile markets or down periods. You buy these put options, and you don't have to worry about placing a protective stop in or volatile price moves or big down moves, because once you buy that put option, you can forget about this trade until option expiration because there's nothing to do. You're already fully protected no matter how big the decline is in the stock market, or if there's bad news for a company. You're fully protected while you own that put option, and you can just place the trade and forget about it until option expiration. So a very low risk, very low stress way to trade.